It's great to have you
Thank you for having
today.
me. Very happy to be here.
So Evelyne is the head of investor relations for Group RMC. She's a principal with the firm. I basically want to thank you for being a member of FLIA for over 3 years now. It's great to have you. And since my first early interactions with people in your firm, everything has been very, very, very professional. So it's great to have best of breed asset managers, investors like yourself involved in our organization. For those of you that don't know Group RMC, it's a real estate co-investment group that invests in office, in underappreciated office properties. They're value investors, and we'll get into that. They currently own over 20 million square feet of property, and it's located in the Midwest, and they have a little bit of exposure in the south part of the US. But with that said, I would like for you to give a background on your story so that our group can get to know you, who you are, and for those that don't know RMC, Group RMC, tell us the story.
Well, thank you, Michael. And so I was listening to you talk about your origins, and we're from a real estate family and sort of those early days when things are getting built up and all the family members working together. That really resonated. You know, as you mentioned, at this point in time, Group RMC is at the size and scope of almost an institutional real estate group, 20 million square feet across 14 US states, a portfolio of real estate worth 2.5 billion US. But the origin story is very much just friends and family, old school, back of the napkin deals, co-investing together. And I guess I can give you a bit of the origin story. It really all started when, so this is a family business. My dad built it up with my brother in 2011, Group RMC as we know it. But before that, when he was just a young man in his 20s, he wanted to, he was building a career in the financial services industry like you. And he sort of didn't come from, any kind of wealth or money or real estate or anything like that. And he was like, those big real estate families, how do they do it? I want to learn that, And so he had a mentor down here. We're in Montreal, I'm Canadian, and then I live in Montreal, although the firm is based in New York. And so he had a mentor, and the first sort of acquisition window that they saw and took advantage of was during the savings and loans crisis down in Texas. So he and a small group of friends went down there, and they were just gobbling up this multifamily real estate that was going for a song, because it was, splashed all over the newspapers. It's a nightmare down there. All the institutional money was staying well away. So you had a few private investors just gobbling up at this, crazy low prices, really fundamentally sound, healthy real estate that for non-economic reasons was just being, sold off at discount prices. So they put together a portfolio multifamily, and Sam Zell's, one of Sam Zell's REITs, Equity Residential, came knocking, and so they had an exit, got rid of all of that, and that was their first successful sort of foray in U.S. real estate. And then everybody sort of went back to their day jobs, and then we became active again, acquiring real estate in the 90s. So for those of you who aren't familiar, Montreal is in Quebec, which is the French-speaking province of Canada. And in the mid-90s, there was a movement for the province to separate from the rest of Canada. And so massive depression of the real estate market, huge political instability, capital fled to Toronto. It was a bit of a mess, but you had all this real estate that was going at incredibly low prices, and the rent checks were just as good. It's just there was this market sentiment that a moment of crisis where the pricing just didn't reflect the fundamental value. So same group of friends and families, oh, you want in? Yeah, sure. Back of the napkin deals, started putting together and developing a specialization in office real estate at that point. So, started buying office real estate in non-primary markets across the province of Quebec, Sherbrooke and Granby and Quebec City and Jonquière, places you've never heard of. Put together about over 2 million square foot portfolio of office, and ended up exiting and selling most of that to a Toronto listed REIT that came knocking sort of in the mid 2000s. And so that was our second sort of successful, acquisition experience. And then what happened after that is after the great, and everybody sort of went back to their day jobs and kind of was waiting for the next window to open. And the next window opened after the Great Recession in sort of 2009, 10, in those years. And we started sort of sniffing around the US. We loved the idea of investing in the US, the idea of sort of skimming off the top of, middle America, that churning, powerful economy that the whole world looks to. We sort of wanted a slice of that, but weren't quite sure how to get in on it. So we started finding opportunities where the pricing was interesting in the Midwest, Indiana, Cleveland, Columbus, these sorts of markets, Kansas City, and started finding really good pricing on office portfolios. So in 2011, we made our first acquisition in Fort Wayne, Indiana, and it was really pure co-investment. It was sort of just a natural outgrowth of when it was just a few friends and families co-investing together. But we said at that point, there's a real business we could be built here. The opportunity is huge. So in 2011, we formed a formal co-investment group. My father founded it. My brother, Alex, who's president of the company today, had been working in private equity, gone to Wharton, smart guy. And so we formalized the group and opened it up to family offices around the world. And so deal by deal, investment by investment, portfolio by portfolio, we now got to the size and scale that we are, staying true to those real old school co-investments. And I'll talk about that, but it's reflected in the value investing approach that we have, and also in the way that we structure things.
So before we go any further, tell me about how people that are interested, in learning more about Group RMC and some of the deals that you're putting together, how do they, like, what's the process? How do they, tell me a little bit about how you familiarize potential investors with the properties and stuff like that.
Yeah, for sure. So we have really developed the way we source our deals is over the years, we've really developed a specialization of being liquidity providers to large institutional sellers who are offloading healthy real estate, usually large portfolios, for non-economic reasons. So you'll have an end-of-life real estate fund that promised their investors an exit after 5 or 6 years, and they're on their second extension and they just need to offload this. We've bought a lot from pension funds. We've bought about 3 million square feet from Blackstone. We just bought a bunch of real estate from UBS. We announced a big disposition program. So you have these big sellers who just want, to realize their exit strategy, reposition capital, whatever it is. And on the other side, you just don't have very many buyers who can cleanly and reliably close on 700,000 square feet, 1 million, 2 million square feet at a time in suburban Kansas or Cincinnati or, Tulsa, these kinds of markets.
We're going to get into that in one second. Yeah. But what I want you to tell me about is, if I'm looking to invest $1 million and I want exposure to a broad, portfolio, I want to come in through your fund. I know that you have the fund structure, you have the co-investment structure. Yeah. Those are two completely different. What's the process to come into the fund structure? What's the experience that I can expect?
Okay. So when we have a deal under contract, we wrap it into an SPV, and then we just send out word that this deal is available to our community of investors and co-investors and family offices that we work with around the world. And then equity comes on a first come, first serve basis. So our traditional business is deal by deal, portfolio by portfolio, investors choosing to co-invest one deal at a time, they remain their own investment committee. And that's how the majority of our co-investors work and work with us. So they build their own real estate portfolio deal by deal. What we saw in the last few years is there are a lot of multifamily offices, there are a lot of wealth advisors who would rather do their due diligence on the overall strategy, but not have to pick deal per deal. So we developed a feeder fund. So it's called the Master Co-Invest LP, and we set it up in 2019. And what happens is you can make a large commitment, and then that money will be put to work within 12 months in the new deals that we acquire. So if you invest at time one, you automatically participate in all of the deals since we started that vehicle in 2019 and going forward. So there's automatic diversification built into the vehicle. We're agnostic. It's the same underlying real estate. It's the same fee structure. It's the whole thing's the same, but it's just a different experience for the investor. So, we like to offer that. And it's been a very successful endeavor. We've got one in Canada and in the US. And so it's an open-ended evergreen feeder fund that invests alongside family offices as an LP in each one of these co-investment deals.
So will you allow these prospective investors that are obviously qualified to do on-site visits?
Oh yeah, definitely. Of course. We have offices in New York. Our head offices are in New York, Montreal, where a lot of the relationship work happens. Our asset management team is based in Columbus. And what we do also pretty frequently is maybe once or twice a quarter is we'll put a small group of investors together. This is for those who are looking to develop a significant long-term relationship with us. And we'll actually do a property tour and go visit, 5 or 6 different markets in 48 hours. So we'll sort of, fly private and, do the whole thing and tour the properties and meet the teams, and they get to know us. And because, it's real old school long-term co-investment. So we're really building a relationship. These things cost us an arm and a leg, but they're worth it, because when you're building these kinds of relationships, it really is an investment. And, if we have co-investors who call us up and say, hey, I'm going to be in Cincinnati on business, can I tour PNC Tower or Huntington Tower? Of course, and we'll call the management team and they can go check it out, see how the lobby redo is doing, So we're like an institutional sized real estate group, but we sort of run it like a mom and pop shop on the relationship side. And we're very proud of that. And I think it's part of our strength. But yeah, for sure, you can tour the portfolios and what's under contract, check it out for yourself.
I think that's very unique. I think that's very unique. And I love the way that you guys do that. It's very impressive. And I also like how this Montreal family ended up being, one of the largest landlords or investors in Midwest office space. That's a very interesting story. I want to drill down into that.
Yeah.
I want to hear more about the DNA.
The DNA. Yeah. So like not unlike you, and I'm sure many people tuning in and many families who invest in real estate, it's sort of like a humble beginning story. And we just stuck to our guns. We just stick to our principles and just patiently, deal by deal, put this portfolio together. And I think a really important sort of quantum leap in the business was in 2017, I believe. We closed on our largest acquisition so far. We were still like essentially a startup at that time, but we closed on a $295 million acquisition, a $2.2 million square foot portfolio in Overland Park, Kansas, a suburb of Kansas called Corporate Woods. And it was one of these things like, oh my gosh, how are we going to pull this off? We had the deal under contract. And like my dad used to say, sometimes in a business, you need to sort of jump off the cliff and build a plane on the way down. And
I love that.
Yeah, I know. And so it was one of those step ups, and we closed on the deal successfully. We bought it from Honeywell Pension. So I forget what cap rate, but it was, we're always buying in the sort of 8 to 10+% cap rate, even today. So that's one metric. So that's the unlevered yield on in-place NOI. It's perhaps one of the most important metrics we look at. And so we closed on Corporate Woods, and that really put our business on the map. It gave us seriousness and credibility amongst sellers, amongst these institutional sellers who find themselves in a position of being forced sellers. And it was just a real step up in the business. And since that time, we really have been focusing on acquiring and holding large institutional sized portfolios. And what we're able to do is, because we're a co-investment group and accredited investors, can invest directly in these deals. These are the size deals that, normally only like Goldman Sachs and UBS and the Norwegian Pension Fund can access, right? They're out of range for even the largest family office, because you wouldn't want to concentrate that much money in just one portfolio of real estate. So it's really kind of democratized that kind of deal. Now we can access, even today, especially today, kinds of yields that are very difficult to find in other assets of real estate. So,
So
yeah,
it's
I think,
interesting how the size of the deals that you're
Mhm.
doing,
Mhm.
and then who you're buying the properties
Mhm.
like from. That's very impressive. These pension funds, why are they letting go of properties at value prices?
Yeah.
And then a follow-up on that question
Mhm.
is, I want to understand more about like how you define value investing,
Mhm.
what that means to your firm, specifically from a financial perspective.
Yeah. No, totally. That's a very good question. So in the first part of your question is why are sellers selling these deals at
Big
these locals?
institutions, big
Yeah, exactly.
institutions.
It's not only big institutions. Sometimes it's, families reorganizing for estate purposes, can be end of life real estate funds. Sometimes it's like a JV between a local operator and a big institutional. Like we bought something in Milwaukee it was a JV by GIC, which I think that's the Singaporean sovereign fund, I believe, and a local operator. And they had realized their business plan. They had a big vacate, and they were on like this. They had kept their JV going longer than they intended to. They just wanted out. They just wanted out. And so you have different stories like that. And what you have to remember with these institutional sellers, when you're buying from Blackstone, you're not buying from Blackstone, the smartest people in the room. They're doing wonderful work. We're not smarter than them. You're dealing with the disposition guy who has, his own incentives, his own timeline he has to work with. There's a business plan he has to realize. He has these couple of assets that he just has to offload so he can go to the committee and tell them the job is done. He doesn't want to be dealing with a buyer who's going to retrade him at the last minute, change the terms, and he's got to go back and say the deal fell. You're working with a big institution with its own logics. So from their perspective, from the seller's perspective, what are they looking for? They're looking for a reliable partner on the other end of these acquisitions, somebody who's not going to retrade them, change around with the terms, who's going to give generous terms, who's going to be on time, come through with the deposit, come through with the final payment. It's just a reliable, clean partner to transact with. And Group RMC, we like to say that we're the nice Canadians. We're the nice Canadians, won't retrade, always on time. And we're a real pleasure to deal with. And we've really cultivated this reputation amongst these markets and amongst these kinds of sellers to know that with Group RMC, you might not get the price that you wanted, but you get certainty of close. And when you're in the thinking of these institutional sellers, they're willing to take a haircut on price because that's very valuable to them. And you wouldn't believe how many deals were the second, third, fourth, even highest bidders on. And we get awarded the deal because they're not just looking at who'll give them the highest price, they're looking at who will be a reliable, clean partner to transact with. So that's one of Group RMC's edges, I suppose. Our secret sauce is just that we have a pristine reputation as being
you're invited in. You're invited in to bid.
Yeah. So we have deep relationships with brokers in all of these markets, deep relationships with the kinds of sellers. It's a big swath of territory. It's, all of large office and Midwest and Southeast. It's a big world, but it's also a small world. So, we're sort of a known quantity. We find
is most of the properties off market, and is it what's the mixture?
It's a mix. No, they're not all off market. Some of them, especially post-COVID deals we've done, some of the beautiful post-COVID deals we've done, there was an active, sales process going. Some of them were already under contract. Some of them had 30, 40 groups circling around them for some of these deals. I'll talk about them after, give them an idea of what kinds of deals we're talking about. Like the Bank of America Tower in Jacksonville, Florida, for example. You can Google it. It has its own
home state.
Oh, your host. That's why I was like, let's do a shout out for Florida. We made our first acquisition in Florida, closed on it in December 2020. So first, mid post-COVID acquisition. And there were about 40 groups circling that because it was a really class A+ 42 tower, iconic part of the Jacksonville skyline. Post-COVID, everybody was in wait and see mode. Everybody sort of was, and so the seller, which was a Hertz Group out of LA, they were looking to reposition some non-core assets and roll their portfolio into a REIT, and they were motivated to sell. And so we bought 2 properties from them through COVID because, sellers just had a bit of a fright moment. And so we were able to come in, and after a successful transaction with them in Columbus, buy this property at $108 a square foot, which is, we will be talking about that for the rest of our lives. It is just an absolutely incredible deal. That's like, calculate how much rent you pay in Manhattan per square foot. And we were able to buy this.
How long do you intend to hold it for?
Good question. So we have an indefinite hold period. So we don't, we'll never be in a position where we're forced sellers because, time's up and we promised to sell at a certain date. You can't guarantee it's going to be a seller's market at a certain date. So we're not opposed to selling one day, but our favorite hold period is indefinite. We have now 109 buildings in our portfolio. We've sold, I think, 1. And it was a really exceptional situation where you had 2 different healthcare systems in suburban Columbus who wanted this spot and whatever. But it was, by and large, as my dad used to say, if you have a cow and that cow every day produces milk for you, and then once in a while it throws a veal your way, why would you kill your cow? So it's quick coupons, quarterly distributions. Once in a while you get to refinance and, cash out that increase in value. And then at the end of the day, you've got your initial capital back in your pocket, in 7 to 10 years, and you still hold the income producing real estate. That's the way we think about it. We're in it to be real long-term as a family and as investors, and our co-investors are of the same opinion, long-term holders of real estate, not slow motion brokers where you buy it, you hold it for X number of years, you sell it, you collect your fees, and you rinse, wash, repeat. God bless people. There's a lot of money to be made in real estate that way, but we're really in it to be landlords.
I can relate to that through my family's experience.
Yeah.
The average hold time was 65 years.
Yeah, exactly.
Right? So, but as an investor, right, that may need their capital, how do they get their capital back?
So, we're not here to hold people hostage. We want to make sure from the get-go that philosophically we're simpatico, that you're comfortable with a very long, hold period, that you don't invest money you'll need in 3 years to buy a house or whatever, clear about that up front. That being said, we work with, I don't know, a couple of thousand families at this point, from the very large family offices with teams of 20 people to, accredited investors, entrepreneurs, people from all walks of life. And so we have a large community of co-investors who invest in these deals with us. And once in a while, every quarter, you'll have a few here and there who want to sell their LP shares because they, estate reasons, divorce, whatever, life happens. So what we're able to do at that point, it's not a liquid security. There's no automatic redemption or anything like that. We don't want to be in that position, but we're happy to facilitate on a best efforts basis a secondary. So either our family or some of the big families that we work with can buy back those shares, usually at a slight discount to the the basis they came in at, but they've been collecting distributions the entire hold period, so evens itself out. So that's usually what we'll do. And we're building a platform now actually to facilitate sort of matchmaking, a secondary matchmaking community, if you will. It's going to be a nice online thing. We've got Roy on our team, who's a tech just whiz, put together our whole CRM. Anyway, so that's a cool project we're working on. But for now, it's just on a best efforts. You contact us. But we want to make sure that people know that that's not the point of this, but we're happy to facilitate a secondary. Another option is, I mentioned those feeder funds that we have. Whenever those open and issue new units, they can also buy out, partners in previous deals, because those funds, would love to have that exposure to these wonderful past deals. So, those are 2 options that are open that, we make use of every quarter. It happens, but we just don't want people to think that it's like, it's not meant to be a liquid asset, right? We think of it more like infrastructure than something.
It has to match.
Yeah.
It has to match.
The philosophy has to match right from the get-go. Yeah.
But I love the strategy. I mean, it's very, very interesting. Tell me, sorry.
You were asking what it means to be value investors.
Let's go there.
Let's go there. Well, this
Let's
whole
go
thing
there.
goes to a lot of the people who tune into your events and participate. We really focus on long-term fundamentals. So for all of our acquisitions, there are certain things that we always focus on. The first is pricing, basis. So when you buy real estate at a low basis, you create a tremendous amount of value and really interesting yield. So that's really the first thing we look at. So, you know, our acquisition criteria are sort of cap rates in the 7 to 10% range, which is, you know, very high compared to what you'll see in gateway markets and, you know, and that's one of the reasons why we're in markets where the crowds aren't, right? Because our business plan is not about, you know, riding momentum, riding waves so that you can exit in 5 years at a higher price than you bought it. These are markets where prices are more stable generally, and where there's just a mismatch between the flow of funds and the real estate on offer. So that's one thing that long-term fundamentals, the price, being in less crowded markets, sort of overlooked markets. That's why we're in the quote unquote flyover states. You know, a lot of institutional funds and all of these, you know, they stay in markets where there's a lot more churn, because that's part of the business model when you need to exit after a fixed number of years. We also, one of the things that we look at, so when we're considering acquiring a property, we don't start with some kind of macro analysis or philosophy. Is it like, are millennials going to, you know, move to the suburbs in the next 10 years? So we're placing our bets on that. No, there can be positive, you know, tailwinds if those things realize, but fundamentally we could look at the deal first. Do the numbers make sense? And then we consider the market. Is this a market we want to be investing in? And so when we consider that, we're looking, one of the main things we look at is supply constrained, right? So we want to be in markets where the going rental rates don't justify new supply, because you don't want your competition, for it to make sense for them to build a property right next door to yours and steal all your tenants. So you want to be in a, you know, property where the returns are good and where you can be quite certain that there's not going to be, you know, cranes popping up left, right, and center, because you know, you want to be in a place where the rents don't justify new supply. So discounts to replacement rates are one of the main criteria that we look at. So we look at discounts to replacement costs of about, I don't know, 50, 60, and into the 70%. So huge discounts there. We also look for the quality of the leases, the quality of the tenants, and the diversification of the tenants. So we don't buy empties. We don't buy single tenant properties. And in any portfolio that we acquire, we don't want any single tenant, however good, however great the terms of the lease, to represent more than 8, maybe 9% of the rentable square footage. And that's really because you want to minimize tenancy risk. You know, my dad always used to say it's better to own a little bit of a lot of real estate than a lot of little. That's reflected in the way our business is structured, and that's how our co-investors think about it too. You also don't want all your baskets riding or your eggs in one tenant's basket, where you lose a big lease or something happens and then you're really in trouble. You never want to be in that position. So we look at the quality of the leases. Commercial leases are interesting because they're long-term, right? So across the portfolio, we've got a weighted average lease term of, what is it now? Like about 5 years, something like that. It varies. Some portfolios it's 7, 8, some it's sort of 4.5, 5. But on average, we're looking at longer lease terms. And so that's something that we look at, the quality of the leases and the long-term tenancy. Multi-tenant, you want to be in markets where you can put the top leasing and management teams in place. So an important point about our business is that we don't self-manage. We're not vertically integrated. We're not our profit center is not fees collected on management or anything like that. In fact, we don't charge any ongoing fees whatsoever. There's a one-time markup on the price of the unit in the deal. We take that in sweat equity, and then it's pure co-investment going forward. Can talk more about that, but what that means is that we have large corporate contracts with the third-party management and leasing companies, the CBREs, the Cushman & Wakefield's, the Colliers, these businesses that are specialized in that. That's all they do. The ones that have, you know, teams of, you know, 7 roaming vans of engineers, you know, just in Columbus, Ohio. Like, you know, the professionalization of the management as a field of expertise in the States is really unparalleled. We couldn't do it ourselves. Plus, we don't really want to be managing like hundreds of people, you know, from an HR perspective. That's not the kind of business we're in. We're an investment business. So we found it better to use third-party managers and leasing teams. So whenever we enter a new market, we like to get to 500,000 and 1 million square feet of real estate in that market sort of as quickly as possible, because that scale allows you to draw the top talent. So whoever the top guy or girl is in any market on the leasing and management front, that's the team we want to work with. You know, doesn't really matter what company they're with. So you pick your people well. And then we have a team that oversees all of these third-party teams that are ours, Group RMC, based out of Columbus. And so they're constantly flying across the portfolio, constantly keeping an eye on things, constantly seeing, you know, what's the state of affairs, how's the leasing going, constantly how is the lobby redo, you know, really on top of things, but not changing light bulbs ourselves. So that's another important thing we look at, is the teams we work with on the ground. Another sort of value investing approach that we have is to be conservative with leverage. So, you know, we've seen it through COVID. A lot of the real estate groups that have gotten in trouble were the ones that were levered up to here, and then didn't have capital reserves, you know, to get them through a bit of a crunch. So, you know, we favor long-term fixed rate CMBS debt, so that you have that sort of predictable expense going. Sometimes we'll put
What term?
What term? Like, yeah, like 10-year.
10-year.
Okay. Yeah. Sometimes we have value add deals where there's a stabilization through lease up that has to be done over 2 or 3 years. So we'll put a bridge loan on that and then put long-term debt on as soon as possible. So we're looking at an LTV of sort of 60% tops. But when you take into account the cash reserves that we have, it looks more like 50 to 55%. So that's really something that we're quite adamant on. We look at the break-even occupancy. So, you know, when you're conservatively structured, even if you're buying a value-add deal where occupancy is at 65%, like the Jacksonville deal, they had a big vacate and they didn't want to put the money in to re-tenant the space. So it's at 65%. It's
65% occupied.
Yeah. So, and it's
that's
still
not typical of all your deals, though, right?
No, it's not. No, that's only when some of them are already stabilized in the sort of 80s, 90s, 100%, and there's no work to do on them. There's no further value to realize through lease up. But you know, when you have deals like that, you're always, even when there's a value add to do through lease up, the break even occupancy is still 10, 15% lower than that. So a lot of, in every way that it's possible to have downside protection, we build that into the deals. We also capitalize the deals up front with a ton of cash reserves, and we constantly replenish the operating cash. So distributions are usually in the sort of 6 to 8% range, cash on cash, but that's free cash flow after you've paid down your debt and after you've replenished your cash reserves. So that's just a prudent way. It's like the way you run a household. You know, you need to have money saved for a rainy day. You don't know what's going to happen.
How do you guys pay it? Do you pay it annually, quarterly?
Oh, that's a good question. Oh, distributions?
Yeah,
distributions are paid out quarterly.
They're paid out.
I receive my distributions literally in the mail.
Nice. Check. Old-fashioned way.
Yeah, old-fashioned. But yeah, the distributions are paid quarterly. Exactly. And then you'll have you know, refinances periodically, and then that usually triggers a special distribution.
So look, we have around, let's say 15 minutes left. I want to get through so much stuff.
Yeah.
My ADD is kicking in, right? I have so many different things that I want to drill into. You know, let's back up for 1 second and discuss you know, since the pandemic, how have the macro factors changed with people working from office versus working from home? And I don't know if you can talk about your conversations with some of your tenants, but their views on employees working from home.
Yeah.
Can you give us some insight into that, please? And I know that's not your investment philosophy, but
no,
I'm
it's
interested in it.
It's really, really important. So you're very right to point out that right now, people are kind of down on office real estate. And I am excited to talk about this because what we've actually seen in the portfolio really shows that it's what people are saying about office real estate and how it's performing and what its future is very different from the data that we're collecting from now a 20 million square foot portfolio. So I think it's sort of this is this the end of office narrative is a little ephemeral. It's like sort of a fashion at the moment. And I say this because we've been investing in office real estate for over 25 years now. We've seen other moments where people were asking themselves, is this the end of office? We've seen the open plan revolution. That's it. Walls are coming down. Work will never be the same. People don't need the office. And of course, things return to semblance of normal. And then there was the WeWorks revolution. That's it. Fundamental change. People don't need offices, and that was another big conversation we were having as a society. And after each of these moments, after some time, the new normal looked a lot like the old normal. And we really, take our lead from Sam Zell on this, who was very vocal about the fact that once this period is over, people need offices, to work, to develop a work culture, to do sales work, to train new employees, to collaborate. We really are firm believers that an office space in terms of productivity is like an ephemeral human, not a perennial human need, in our economy. So we're not really worried about the long-term, either the long-term future and need of office space in our society. What is interesting to point out, however, is that there seems to be a difference in what's happened in the office real estate market in gateway markets versus non-gateway markets. So gateway markets, the San Franciscos, the Bostons, the New York Cities, the sort of traditional major hubs, where there seems to be a really painful, because they were so expensive to begin with, there's a sort of a lot of kind of blood being spilt in those markets. And in the non-gateway markets, it's actually been like the ones that we're in, that we've always been in. It was the same during the Great Recession. The highs are not as high and the lows are not as low. So things have remained quite stable. And, we don't have a crystal ball. I don't know what the future holds, but, you're very right. There's probably going to be more flexibility in how people work. People will probably include more remote work in how they run their businesses. But what you'll probably have is employees, who will say, well, why do I live in New York if I can live in, a market where the cost of living or my quality of life is better, cost of living is lower? There's got to be some demographic shifts. You'll have employers who will say, why do I have 5 floors in the most expensive real estate market in the world when I could be, doing some of my work out of a regional office in Jacksonville or in Cincinnati or, so we're not banking on the kinds of demographic shifts that are going to happen. We think they actually might end up favoring non-gateway markets, but that's not what we're banking on. What we're banking on is each deal that we do. Can we keep this building profitable? Can we, with our, reserves and our money we're able to put in and the way we structure our deal, can we offer a high quality product to the tenants in that market at a lower price than our competition and keep the building profitable? And that's the beauty of buying at a low basis, and when you have a long-term time horizon. Yeah.
Just so you know, I believe employers want their employees back at the office.
Yeah.
And I believe that there's a lot of reasons behind it.
Mm-hmm.
I don't know if you want to speak to any of those conversations.
I mean, we're business.
I'm trying to get some of the,
like, things are a lot better since we started going back to the office. Just things that,
forget your business. Let's talk about maybe some tenant stories. Don't name anybody in particular, but why they want their employees back in the office.
Yeah. Well, okay. So I think an interesting thing to point out is lease renewals and what we're seeing in the aggregate data on lease renewals. So one thing to mention is throughout the pandemic, we've collected 98+% of the rents. So rents have been stable. We've fully collected the rents. What we saw during the pandemic was, when a lease comes due, it comes due. It doesn't care that you're in COVID. It doesn't care what the economic conditions are. It comes due. And so we were seeing that leases that came due in the sort of period from March 2020 to kind of the fall, I guess, late summer, fall of this year, tenants were renewing, doing short-term renewals. They were sort of kicking the can down the road and taking a wait and see approach. And that's something we saw across the portfolio. And what we've seen in the last few months is long-term normal leasing activity pick up again. And that, that means that tenants are feeling comfortable and confident again, making longer term commitments to their space. So we're not seeing any massive flight, no massive downsizing, nothing like that. What we're seeing, the signal that we're getting from the portfolio, from our tenants, is that they can start thinking about the future again. And that's a really important signal.
We got a comment from one of the real estate guys inside of our group.
Yeah.
Did you see it?
I see Dave. Yeah, there's David asking a question. Well, it's more of like a comment. He says, a friend told me that there are some people who don't like to work at home with spouses all day and will always need offices. I don't have kids myself, but my goodness, working at home with kids and an apartment, pets. I mean, listen, I think a lot of people's personal experience with this working at home, some of them had a very positive experience. Anybody who's in sales, anybody who needs to be on Zooms all day long, who's in the people business, service economy, working from your guest bedroom has its limits. So, we'll see. In the last,
I've heard a couple of stories where people are working 2 and 3 jobs at the same time, right? So as an employer, do you really want to pay a full-time salary to an employee who is working, for possibly your competitor?
I've heard stories like that.
I mean, it's just, let's be serious.
You know what, Michael, I will say one thing. Let's say you have 5 or 6 or 7 year money that you're looking to invest. You have to be careful, and you're trying to time things. I can understand why they would think twice about office reals, because it's not clear, things aren't going to return to full steam ahead to normal like a light switch. You see it happening more quickly in the South than in other markets. It's going to happen gradually. We're confident that it's all going in one direction of people returning to the office and a new normal looking very much like the old normal when this pandemic moment, passes, when this crisis passes. So wait, what was I saying? Lost my train of thought.
You're saying that if people have a short-term perspective,
yes, exactly,
that this isn't the right thing for them.
Exactly. But if you've got a like intergenerational long-term wealth building perspective, this is one of those once in 20-year buying opportunities. We are hoarding, we are gobbling up as much of this real estate.
So there's deals to be done, there's discounts. This is unlike hospitality, where hospitality, everybody's like back to business as usual. There's still discounts available in the office space.
Yeah, our latest deal now that we've got Americana IX, so what we did is we took 11 different properties across Milwaukee and suburban Chicago, wrapped them into one nice internally diversified SPV, and then co-investors invest in that. So automatic exposure to different markets, over about a dozen properties to how many, I think 130 different tenants. So we acquired that at a 10 cap on in-place NOI. And it has value add potential because one of the properties is about 50 or 55% occupied. So it needs to get leased up, the property in Milwaukee. So just the yields that we're finding. I mean, there was a deal, a suburban portfolio deal we did in Detroit late last year. We had lenders tripping over themselves to try to provide us, debt, because yield is so hard to come by, right? What they do is they wrap up the debt with other maybe less crappier debt, and then slice it off and sell it to the street. So they look to our deals to sort of anchor their CMBS product.
To enhance.
So there's yield to be found, but you need to find your niche where you have a mispricing happening. And that finding a niche in a crisis has been part of our DNA as real estate investors since the very beginning. So this is really one of those, this is the time to accumulate assets. And so, this is what our co-investors and we do. So we've got this deal, Americana IX, happy to talk about it with anybody who wants questions, but it's being,
What's left? What's left?
What's
How
that?
much? Yeah, like how much
We're
space
about a third of the
is
way
left?
through the equity raise on that one. Yeah.
Okay.
And all of the feeder funds will be participating in that, obviously, as they do in all of our deals. It's 1.3 million square feet, 11 Class A and B buildings. We've got a weighted average lease term of 5.3 years. So nice, long-term, sticky, bond-like rental income coming in. Break-even occupancy of 47% with an in-place occupancy of 72.3 with room for lease ups. So this one's distributing 6% cash on cash distribution starting the first full quarter after close. So that's available now. And then we just
What's the close? When's the close on that?
We're looking to get wires in on this one mid-November.
Mid-November?
Yeah, happy to send information. We put a nice video together with drone footage, and not everybody can travel to Milwaukee and on a dime. So happy to share, any information I can. It's an absolutely beautiful, probably classic Group RMC deal. 10%
For qualified interested parties,
yeah.
are they
Accredited
able?
investor. Yeah.
Are they able to do like on-site tours?
Yeah, sure.
Is that a possibility?
Yeah, reach out to me. We can certainly plan that. I've got a group right now in doing a due diligence trip, and they were passing through Milwaukee and Chicago yesterday, and then they were on down to Houston. We have another deal in Houston. There's maybe between 1 and 2 million left in that one, wrapping up in the Galleria. Beautiful, 22-story.
So 1 to 2 million's left in that deal?
In that other one, and this one is a large acquisition. So I think the total acquisition price it's a $90 million acquisition raise. So it's a nice juicy one. So reach out to me. I'm happy to share more information. But I think the point of today was to give you a sense of like how we think about real estate investing, to see there's a pattern, and then the specifics of the deal.
It was very educational, very informative. We got into a lot of different stuff. We covered a lot of territory.
Yeah.
I hope the people on the Zoom today, got to understand the DNA and the way that Group RMC thinks and structures the deals and the time horizon for the deals, the return, the basic principles of wealth creation.
Yeah,
that
exactly.
are the pillars behind your firm.
Thank
So
you.
I hope that we can follow up with the people on the call today in a timely fashion. And if there's anybody that's like interested in participating in either the fund or a little bit of co-investment opportunity in Houston, that
Or
you
this
can
Americana
connect.
9 deal too. Yep.
Yeah, I mean it was great. I loved your views.
Thank you.
I loved your views.
Remember when we were like, oh, are we going to be able to fill up an hour? How am I going to talk for an hour? Of course, it's never a problem. So thank you for everybody who tuned in.
You only wanted to talk for 30 minutes.
I know. I was like, what am I going to say for an hour? It's never a problem. When it's your own business and you love it and you're passionate about it and you're happy to be building wealth and working with your partners, it's all good.
You described Miami to me a little bit in your investment strategy, not Miami today, but maybe Miami 8 years ago. So like it wasn't wishful thinking, but that replacement cost and some of the metrics that you go into, Miami was considered a secondary city, right? It wasn't really considered what it is today. But a lot of now, is there any chance that you guys would be looking to buy properties in Miami or have a presence in Miami or anything like that?
I'm so glad you asked. So for the moment, the pricing in Miami doesn't fit what we would be looking for. It's still a very hot, I think it'd probably be considered a gateway market or one of these very key real estate markets. However, we are opening offices there early next year so that we can meet with partners and co-investors and wealth advisors. So hopefully be, spending some time together. And because we do have a lot of, it's also the gateway to Latin America. You know, we have co-investors on all continents. So it's great to be able to have FaceTime, because as lovely as Zoom is, there's nothing like sort of being belly to belly with someone and sharing a meal and breaking bread. And, you know, that's important. So we're going to have a permanent presence in Miami, not, you know, to buy real estate, but to have relationships with the people down there.
I want to ask you to come down during Art Basel, if that's possible, which is the first week of
lovely.
December. I think
Oh,
you would
first week of
enjoy it.
December. Okay, that actually might work. Okay, let's talk. I would love to.
Okay.
come back. All right.
All right. Thank you, Evelyne.
Thank you so much.
for
Do I
your
log
time.
out now? All right.
Yes. Have a great day. Thank you.
Thank you all. Bye-bye.
All
Thank
right,
you so
bye
much.
now.
Bye.